Hello, welcome everyone to the new episode of Inventory Simplified. I'm your host, Fred Martinez. Today we're going back to school. We're going to learn a little bit about inventory. Have you ever had a customer walk in and ask you, for your best-selling item and you realize you're completely out? Or even worse, you have a ton of inventory, but it's all stuff nobody wants to buy? Well, my friend, that's what happens when you don't manage inventory properly. Today, I'll help you avoid these disasters by breaking down these three things. 1, what is inventory? Well, it's the stuff sitting on your shelves that you can sell. Why is inventory important? Because running out of coffee will create chaos with your customers. And number 3, how do businesses track inventory? No, guessing does not count, okay? So in my experience, most inventory problems aren't caused by suppliers, employees, or bad luck. They start with business owners who don't really fully understand the process of purchasing, receiving, and paying for inventory. But don't worry, I'm here to help. All right, so the first section is, what is inventory? Inventory is just a fancy word for stuff sitting on shelves that you can sell. But it's a little more than that. If you ever looked around your business and thought, wow, we have a lot of random stuff, congratulations, you have inventory. But not all inventory is the same. Let's look at a few examples. First one is a coffee shop. What is inventory for a coffee shop? Coffee beans, cups, bottled drinks. Because without those, you're just a sad, empty room. And if you're like my wife, no caffeine means coffee withdrawals. An auto repair shop, they have tires. They have oil, they have replacement parts, but no one comes in to just admire your wrenches. The third one is a grocery store. Obviously, when you go to the grocery store, they have fruits, veggies, snacks, and all the things we buy when we're hungry and make bad decisions. Hello, aisle full of cookies. So I sometimes wonder, what happened to all the toilet paper during COVID-19? Was it actually used? Or did the toilet paper have an expiration date and you had to throw it out? And right now, with all of this stuff going on, where are the eggs? Like, holy mackerel. The key thing to remember, inventory is anything your business owns with the purpose of selling it. If you can't sell it, it's not inventory, it's clutter. Why inventory matters? If you ever walked into a coffee shop desperate for caffeine, only to hear, sorry, we're out of coffee, then you already understand why inventory is important. Inventory is the backbone of your business. Without it, you're just a store with a cash register and nothing to sell. 3 reasons why inventory is crucial. First one, cash flow. Inventory is money sitting on the shelves. Too much, you're tying up your cash. Too little, you're missing sales. Customer satisfaction. If a customer wants something and you don't have it, they'll just go somewhere else. No one's going to wait 3 weeks for a restock. And profitability, knowing what's selling and what's not, and keeping you from wasting money on things that are just collecting dust. Bottom line, if you don't track inventory, you're running your business on luck, and luck isn't a business strategy. Now we get into the 2 types of inventory systems that you should have and or using. And I wanted for you guys to get a little better idea of what a perpetual inventory, and that's the first one. The option 1 is a perpetual inventory system. I call this one the Karen of coffee shops. This one uses software to track inventory in real time. Every time you buy, sell, or adjust stock, the system updates automatically. Best for retail stores, e-commerce, and anyone who wants to know what's in stock. A perpetual inventory system is like a Karen managing a coffee shop. She monitors every move, checks every supply level, and if something's missing, you can bet she's addressing it immediately. So think of a perpetual system as the Karen of coffee shops, always watching and always updating. Option 2 is a periodic inventory system. I call this one the magic 8-ball effect. You know how you have those little things that you shake and then it tells you, the future or whatever, a question you may be asking? That's what the magic 8-ball approach is. So the definition is inventory levels are updated at specific intervals. So it can be monthly, quarterly, daily, through physical counts rather than continuously. Process. It designates time. Businesses conduct physical inventory counts to determine stock levels and calculate the cost of goods sold. This is best for small businesses with limited inventory or low transaction volumes. The drawbacks: lack of time data between counts. There's no accurate information on current inventory levels, increasing the risk of stockouts and overstocking. Labor intensive, physical counts can be time consuming and may disrupt regular operations. Higher risk of errors. Manual counts are susceptible to human errors, leading to inaccuracies in inventory records. With the periodic inventory system, managing stock feels like consulting a magic 8-ball. You perform a count and hope for clarity. But between counts, you're left guessing whether you have enough stock or not. So perpetual, remember, is the Karen of coffee shops. The periodic is magic 8-ball approach. Inventory answers not always clear. So the final takeaways: for accurate real-time inventory management, the perpetual, Karen at the coffee shop system is preferable. The periodic, magic 8-ball approach system may suffice for smaller operations, but comes with challenges like potential inaccuracies and lack of timely data. The last item we're going to go over today is effective inventory management. Effective inventory management is crucial for operational efficiency and customer satisfaction. However, several common mistakes can hinder these objectives. Here's an overview of these pitfalls and strategies to avoid them. Inaccurate demand forecasting. The issue: poor demand forecasting can lead to overstocking or understocking, resulting in increased cost or lost sales. Solution: utilize historical sales data and market trends to improve forecasting accuracy. Overstocking and understocking. Issue: holding too much inventory ties up capital and storage space, while insufficient stock can lead to missed sales opportunities. Solution: implement real-time inventory tracking and set appropriate reorder points to balance stock levels. Lack of regular inventory audits. Issue: without routine checks, disciplinaries between actual stock and records can go unnoticed, leading to fulfillment issues. Solution: conduct regular inventory counts to ensure accuracy in inventory records. A disorganized warehouse layout. Issue: a poorly organized storage area can delay order fulfillment and increase the likelihood of errors. Solution: maintain a well-organized warehouse layout with clearly labeled sections to streamline operations. Manual data entry errors. Issue: manual data entry mistakes can lead to significant discrepancies in inventory records. Solution: adopt automated inventory management systems to reduce your inventory. Next week on this podcast, we will work in QuickBooks to examine inventory items. We'll set them up, map them to the appropriate accounts, and finally, examine the journal entry side of the transactions. Once again, if you have questions, feel free to leave them. Also, don't forget to click the subscribe button. We'll see you next week for the next episode of Simplified.